The average American household earns about $70,000 a year. The average American household holds about $6,000 in liquid savings. That is 6 weeks of income sitting as a cash buffer between a family and a financial emergency. Not 6 months, 6 weeks. That ratio is not the result of bad luck. It is the result of an unintentional system, one that was never designed by the people running it, never stress tested against their actual life, and never adjusted when the math stopped adding up. 6 months is enough time to redesign that system. Not to get rich, not to retire early on a beach, but to move from a reactive financial posture to an intentional one. And that distance, it turns out, is larger than most people realize. Before any system can be improved, the one that currently exists has to be measured. About 54% of American households report living paycheck to paycheck, according to Lending Club's 2024 survey data. The large majority of them cannot estimate their monthly surplus, the difference between income and spending, within a few $100s in either direction. This is not ignorance. It is a well-documented psychological mechanism that researchers call motivated avoidance. When anticipated information is expected to be painful, the mind routes around it. You delay checking your bank balance after a difficult week, not because you are financially irresponsible, but because your brain has correctly assessed that the information is unlikely to feel good and is protecting you from short-term discomfort at the cost of long-term clarity. The problem is that avoidance has compounding costs of its own. The average American credit card balance sits at about $6,300, at interest rates that have now exceeded 21% annually. Every month of avoidance is a month of that rate running quietly in the background. Month 1 of any genuine financial reset is pure measurement. Net income minus actual spending, documented across 30 days without judgment. The number that results is the only number that matters. If it is positive, that surplus is the engine. If it is negative, the size of the deficit defines the scope of the problem. Either way, you now know where you are. Personal finance has a complexity problem. There are hundreds of frameworks, thousands of pieces of advice, entire industries built around the idea that managing money is technically difficult. It is not. Stripped to its mechanics, there are exactly 3 things that can change your financial trajectory: reduce what you spend, increase what you earn, or reduce the cost of money you already owe. That is the complete list. The cost of existing bad debt is the most important lever because it is the only guaranteed return available to you at no additional risk. Paying down a credit card charging 22% interest is a 22% return on capital, tax-free, immediate, and risk-free. No diversified portfolio of index funds reliably generates that return. Any debt above roughly 8% annual interest should be treated as the highest priority investment on your balance sheet. The second lever is savings rate. Federal data puts the median American personal savings rate at around 3.5%. Research in behavioral economics identifies a threshold somewhere between 15% and 20%, the rate at which compounding begins to meaningfully accumulate wealth rather than merely preserving it. On a $70,000 income, moving from 3.5% to 15% represents about $8,000 a year, or roughly $650 a month. That is a real constraint. It is also a solvable one. The third lever is income, and it is the only one with no theoretical ceiling. Labor market data shows that workers who change employers have historically seen median wage growth roughly twice that of workers who stay. A $5,000 annual salary increase, invested consistently in a broad market index fund over 10 years, compounds to approximately $85,000 in real wealth. That is the math of a single career decision handled correctly. Months 1 and 2 are about measurement and buffer. Calculate the surplus. Then build a 1-month cushion of fundamental expenses, rent, utilities, groceries, transportation, held separately from daily spending. Without that buffer, every unexpected expense becomes high-interest debt. A 2200 car repair at 21% interest is a meaningfully more expensive problem than a 2200 car repair paid from cash. The buffer converts emergencies back into expenses. Months 3 and 4 are debt years. Once the 1-month buffer exists, direct every available dollar at high-rate balances ranked from highest interest rate to lowest. This is not the only debt repayment approach, but the math consistently favors targeting the highest rate first. When bad debt is eliminated, the money that was servicing it redirects to an emergency fund, 3 to 6 months of fundamental expenses, depending on income stability. Month 5 introduces investment. If your employer offers a retirement match, contributing enough to capture the full match is one of the few genuinely risk-free high returns available to any employee. A 50% match on the first 6% of salary is a 50% instant return on that portion of income. The Roth IRA contribution limit sits at $7,000 per year, after-tax money that grows tax-free indefinitely. The S&P 500 has averaged approximately 10.5% annual returns over the past several decades. These are the structural advantages available to nearly every working American that a significant share of working Americans underuse. Month 6 is automation. Behavioral research consistently shows that when savings and investment transfers are automatic, executed before discretionary spending reaches the account, adherence rates exceed 80%. When those same transfers depend on a monthly decision, consistency falls significantly. The goal of month 6 is to make the entire system run without requiring your attention, so that your attention is free to work on the income lever, the only one that scales. 6 months, 3 levers, 1 sequence of decisions, not inspiration, mechanics. Understanding money is your best defense.